Hello, everyone, and welcome to this session in which we'll go back and revisit guess what? The operating section. Remember earlier we did the operating section using the indirect method. Now we're going to be using the DM, the direct method. It's two different methods. They both get you to the same answer, the operating section, just the way you compute this. Now, one method, it's the operating section. If you remember, we took net income and we reconcile backward to the cash net income. Remember, I told you it's called cash net income. The operating section using the direct method is a little bit different. We're going to look at each line on the income statement directly. That's why it's called the direct method. We're going to look at each line. Sales, we're going to take sales, convert sales to cash sales. We're going to look at cost of goods sold. Take cost of goods sold, convert to cash paid for supplies. We're going to look at salaries expense, and we're going to determine how much salaries expense we paid in cash. We're going to look at taxes, tax expense. How much of the tax expense was in cash? Could be the whole thing could be in cash, or it may not be the whole thing. Maybe some of it was accrued. And this is what we need to do to convert this accrual revenue or accrual expense into either a cash revenue or a cash expense. There's going to be a formula for each one. Yes, formulas are good, you can memorize, but understanding it is way more important. And if you understand the indirect method, how we did the conversion, basically the same rules apply, the same logic applies, going from accrual to cash, but doing it slightly differently. We're going to get to the same answer. If you know how to do this, if you know how to convert using the direct method, you'd also be able to go from cash to accrual as well, because going from accrual to cash to accrual is the opposite of it. Important section, an important lesson here. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. The first thing I'm going to do is to remind you that only the operating section will have two methods, the indirect method and the direct method. And in this session, we will work the direct method. In the prior sessions, we looked at the indirect method. If you are not familiar with that method, please go back and review it. We will be using the same income statement that we used for the indirect method because we're going to end up with the same figures. So I want to show you how the direct method will work vis-a-vis the indirect method using the same example. Obviously, if we're using the same income statement, we will be using the same balance sheet. Now, when it comes to the direct method, here's what's going to happen. I'm going to give you a preview of the direct method. In the direct method, you look at each line and you convert into cash. So we're going to look at sales. 7,250,000, and we're going to figure out how much of that sales is cash and how much of it is non-cash, because we're only concerned with cash. Cost of goods sold, how much of it is cash paid and how much of it is not. Wages and other operating expenses, interest expense, so on and so forth. It's called the direct method because we're going to convert each line directly. Now, under the indirect method, what did we do? Under the indirect method, we started with net income, we started with the bottom number, and we made adjustments to come up with cash flow from operating activities. Here, basically, we are starting at the top. How do we perform the conversion? Each line on the income statement, each number, will have to determine whether that number needs to be converted, and if it's need to be converted, is there any need to convert this number? In other words, we look at its sales and we look at related balance sheet account to determine whether sales needs to be converted, and if so, how do we do that? Starting with, actually we're going to start at the top, starting with sales. Now, when we have sales, in your opinion, sales is an income statement account. Which account on the balance sheet is related to sales? And I hope you remember that account receivable on the balance sheet is related to sales. Why? Because every time we debit account receivable, every time we increase account receivable, the corresponding credit should be sales, right? Because when we say we're increasing account receivable, it means we performed the work to some customer and that customer did not pay us. Therefore, account receivable goes up, sales goes down. Now, every time or when a customer pays, we increase cash and we reduce account receivable. I hope you know this much. Now, this gets a little bit more involved when you have bad debt expense and allowance, but in financial accounting, we don't have to worry about this. So to convert our sales, which is $7,250,000, into cash receipts from customer, what do? We look at our beginning account receivable. Our beginning account receivable is $67,000, which is 20x4. Then we would look at our ending account receivable, which is $93,000. We see that the net increase is $26,000. In other words, account receivable overall for the whole year went up $26,000. Now, what else do we know? We know that sales is $7,250,000. In other words, at some point during the life of this company, we debited account receivable $7 million, or at least we have total sales of $7,250,000. We know that much. $7,250,000. We know that much. Why? Because total sales is $7,250,000. Now, some of that sales is cash, some of it is receivable. What do we know? Well, we know that account receivable went up. It means some of that sales was on account. Why? Because if the overall account receivable went up, it means I sold more on credit than I received in cash. How do I know this? Because my account receivable went up, went from 67 to 93. So if I take 67 plus the sales that I recorded of 7,250,000 and I end up with 93,000 in account receivable, it means I collected in cash, I credit account receivable, I collected in cash 7,224,000. And this is exactly what I'm looking for. I'm looking for how much cash did I receive. Now, from a journal entry perspective, this is what it would look like. From a journal entry perspective, I would say I credited sales 7,250,000. That much I know from the income statement. Then, overall, the net difference in account receivable is an increase of 26,000. Therefore, I debit account receivable 26,000. What's left is the cash. Therefore, the overall journal entry, if I net out cash, account receivable, and sales, I'm going to end up with cash debited 7,224,000, sales credited 7,250,000, and I still have $26,000 in receivable that I did not collect. To show you this one more time, of this amount, 26,000 was not collected, non-cash sales, non-cash, and the remainder, which is 7,224,000 is cash. How did I know this? I examined my account receivable. My account receivable went up. Therefore, if account receivable went up, it means part of my sales, the difference in that increase, is sales on credit. Now, if account receivable went down, it means I collected more cash. If account receivable went down, it means I collected more cash than I sold on credit. Because if account receivable, I started at 67 and I end up at 50, what does that mean? It means I must have collected more cash for that particular year. This is what it means. So if account receivable went down, the opposite would have been the case. It means I will take my sales, then add the decrease in receivable, which happens to be, for this example, 17,000. But account receivable went up. It means part of my sales was on credit. Make sure you understand it. Make sure you at least memorize it and reflect on it. So if account receivable went up, it means I sold more on credit. It means if I take a look at my sales, I deduct the increase in receivable from sales. If my account receivable went down, it means I collected more cash than I sold on credit. If I collected more cash, I'll take this cash and add it to my sales because I am concerned with my cash collection. Now let's take a look at cost of goods sold. So we converted sales. Let's convert cost of goods sold. Remember, cost of goods sold, don't remember, I did not mention, it's an outflow. In other words, there's a 4,670,000 in cost of goods sold. I need to convert cost of goods sold into how much did I pay to my suppliers. Okay, cost of goods sold is an accrual amount. I need to know exactly how much I paid. What do? I need to examine two accounts with cost of goods sold. Why? Because when I purchased inventory, inventory turned into a cost of goods sold. But I purchased inventory first on credit. So first I have to determine what's the change in my inventory and how would that change affect my cost of goods sold. What's the change in my accounts payable and how would that affect cost of goods sold. I'm going to do so in two steps. First, I'm going to examine the change in inventory. My inventory went from 186 to 213. Right here, went from 186 to 213. What does that mean? It means overall there was an increase in inventory. Think about this. If your inventory going up, what does that mean? It means you purchased more inventory. It means the increase in inventory, is additional purchases. And at this point, we would assume that those purchases were in cash until we examine accounts payable. But this is what we're saying. But let's reconstruct specifically inventory. So the beginning is 186, the ending is 213. We know from the income statement, we booked 4,670,000 worth of what? Worth of cost of goods sold. Remember, here's how inventory works. When you purchase inventory, you debit inventory for $5 and you credit cash. Let's assume you paid in cash $5. Then when you sell this inventory, let's assume you sold it for, I don't know, $20 in cash to keep it simple. You debit cash 20, credit sales 20. Then what you do, you convert your inventory into cost of goods sold. You debit cost of goods sold $5 and you credit your inventory $5. Therefore, inventory turns into cost of goods sold. And what we did is we credited inventory. Notice we credited inventory 4,670,000, the amount of cost of goods sold. So if we started with 186, credited inventory 4,670,000, it means we purchased, this is a plug, 4,697,000. These are our purchases. So what we figured out is our purchases. We know that inventory went up. It means we purchased more of inventory than we sold for that year, the net effect. But the purchases were 4,697,000, which is $27,000 more than our cost of goods sold. So that's step one. Step two is to determine how much of these purchases, we know we purchased that much, but how much of it was in cash, how much was it on accounts, which is accounts payable. Now we need to examine which accounts payable. We figure out the beginning, which is 140,000, the beginning accounts payable. The ending is 179. The beginning is 140, the ending is 179. And every time we make a purchase of inventory, we debit inventory and we credit AP. I credited cash to make it easy, but this company credits AP. We debit inventory, credit accounts payable, and this is the credit. We know that we purchased 4,697,000. Therefore, I credit this, my accounts payable, this much. What's left is a plug. How much did I pay? Well, it appears that I paid 4,658,000. How do I know this? I need the number that's going to give me 140. I need the number that's going to give me beginning 140 plus purchases minus, this is the X, this is the unknown, minus some number equal to 179. Well, that number is 4,658,000. Therefore, cash paid the supplier is 4,658,000, and this is, I figured out how much I paid in cash. So although my cost of goods sold is 4,670,000, I only paid in cash 4,658,000. You might be saying, how is that possible? Didn't you have more inventory? Yes, my inventory increased. Notice my inventory increased by 27,000. Okay, you might be saying, how would you pay less? Yes, my inventory increased by 27,000. However, my accounts payable increased by 39. Yes, so I did purchase inventory. I agree with you. I have more inventory. That's great. And if more inventory, it means more cash outflow, but that's not the case. I purchased this additional inventory by borrowing, by crediting accounts payable. Well, if you really think about it, if I purchased 27 and 39,000 of it was credit, what's the difference between those two figures? If you find the difference between 39 and 27, it should be how much? 12,000. So the difference is 12,000. It means what? It means I recorded in cost of goods sold 4,670,000, but 12,000 of it minus 12,000 was on accounts payable. The net difference between the increase in inventory and accounts payable. Therefore, the cash paid is 4,658,000, which is 12,000 less than 4,670,000. Now, you have to use your logic, because in your exercise, on your exam, in your textbook, they might have a different scenario. They might have where inventory went down and accounts payable went up, or inventory went down and accounts payable went down as well. You could have increase and decrease. Logic, you just have to understand the logic. So follow what we did here, but use your logic. Just basically plug in the figures. And what we should do, just on farhatlectures.com, you will work more additional practice to kind of figure this out. Now, let's now take a look at another computation. And this is basically, before we proceed, let's take a look at the journal entry. I forgot about the journal entry. So the journal entry overall, our purchases was 4,697,000. We figured out the purchases. Our accounts payable overall increased by 39. We credited accounts payable 39, and the difference is 4,658,000. Simply put, we purchased 4,697,000, of which 39,000 of it was on account, and the remainder was cash, which is 4,658,000. Now let's examine wages and other operating expenses. Wages and other operating expenses, they are related to prepaid expenses. Well, first, let's see what happened to our prepaid expenses. They went from 18 to 15. So your prepaid expense went down. Well, let's think about it. What happened when you reduce your prepaid expense? You are consuming the prepaid expense. What happened to the prepaid expense? When they are consumed, you debit expenses and you credit the prepaid. And the difference is how much? 3,000. What does that mean? It means part of these expenses, 3,000 of it is non-cash. How do I know 3,000 of it is non-cash? Because I used up 3,000 of my prepaid expenses. Well, if 3,000 is non-cash, the remainder is cash, which is 1,771,000. Again, you want to do the journal entry. First, let's examine the T account. The beginning balance is 18. The ending balance is 15. Well, what does that mean? It means there's a difference of 3,000, but we know wages and other expenses, we expensed 1,774,000. We know that we reduced our prepaid, because every time the assumption is every time we paid an expense, we reduce the prepaid. Well, if that's the case, to plug, the cash payment is 1,771,000. And if we look at the journal entry, wages and other expenses, the total expenses for this company were 1,664,000. This is how much expenses we debited. However, we also had this entry, the 3,000. How do I know I had the 3,000? Because of the decrease in prepaid. That means of these expenses, of the 1,774,000, 3,000 is non-cash and the remainder is cash. And this is how I figure out figured out how much cash I paid. So simply put, look, this is easy. And if you understand this, you can understand all other assets. Let's assume you purchased prepaid. If your prepaid went up, let's assume your prepaid rather than decrease, your prepaid increase. If your prepaid increase, it means you incurred expenses and you purchased more in prepaid for future years. Well, if you purchased more in prepaid, it means your cash went down. It means you consumed more cash. But in this situation, prepaid went down. It means you are using your prepaid to record expenses. It means you have less of $3,000 in cash expenses. Let's take a look at interest expense. Now, I mentioned earlier that sometime you could have an expense, and if it does not have a related balance sheet account, then you would assume all of it is cash. But here we have interest expense and we have interest payable. Well, interest expense is $32,000. It says we debited $32,000 of interest expense. Well, if we look at interest payable, it looks like interest payable went down. When do you bring down interest payable? Well, you bring down interest payable when you pay it in cash. So what you do is you debit interest payable $2,000 and you credit cash $2,000. Now here's what we're saying. On the income statement, we recorded $32,000 of expenses. In addition to that, we had to pay cash for $2,000, but that cash went against interest payable. It means in total we paid $34,000 in cash. It means we paid $34,000 in cash. Why? Because we recorded an expense of $32,000 plus we paid an additional $2,000 in cash. Well, let's look at the T account. We started at 8, interest payable went down to 6. Now, expenses were $32,000. How do I know? At interest expense, when we debited interest expense, we credited interest payable. But if we take 8,000 plus 32, how much cash we paid? We must have paid 34. And how did I figure this one out? Well, if I recorded 32,000 in expenses and my payable went down, it means I paid in total 34. In other words, in total interest expense was 32,000. I debited this much, but I also reduced my payable by 2,000, and when I reduce the payable, I have to debit. Therefore, I paid in total in cash 34. Although I paid in cash 34, my interest expense was only 32 because 2,000 of the 34 were interest expense and 2,000 were payable and 32 were for the expense. Now, again, the opposite would have been true if my payable increased. If my payable, let's assume, went from 8 to 10. If my payable went from 8 to 10, it means of the 32,000, 2,000 of it I did not pay. 2,000 of it I did not pay. It means how much did I pay? 30. How do I know 2,000 of it I did not pay? Because my payable went up, my liability went up. But that's not the case here. My liability went down. It means I consumed more cash. Income tax expense. I recorded it on the income statement, $212,400. Now I need to take a look at my related balance sheet account, which is income taxes payable. So notice here my liability went up. My liability went up by $6,000. Well, what does that mean? It means of this amount of the $212,400, $6,000 of it I did not pay. How do I know I did not pay? My liability, my related liability went up. It means this is a non-cash. It means the remainder of it is cash, $206,400. Therefore, my beginning balance is 18. My ending balance is 24. There's a change of 6. There's an income tax expense recorded of $212,400. It means I only paid. So if I want to go from 18 plus $212,400, how much did I pay? I paid only $206,400. But I just showed you that if payable went up, it means I did not pay it, reduce it from the expense, and you should be fine. I'm showing you the journal entry. If we want to see the overall entry, my expenses were $212,400, of which $6,000 were payable. I credited the payable. I did not pay it. If $6,000 is payable, how much is cash? The remainder, $206,400. And this is the overall journal entry. Now, Let's compare the indirect method real quick with the direct method. Under the indirect method, and we looked at this in a separate recording, I started with net income and I performed various reconciliation to come up with net cash provided by operating activities 554,600. Under the direct method, oh, well, I skipped something. Let me go back and you're going to be saying, why did we skip the other income statement account? Let me clarify this. I'm glad I remember this. I skipped depreciation. I did not convert depreciation. Why not? Because depreciation itself is a non-cash expense. So if there's a non-cash expense, you cannot convert it into a cash expense. It's a non-cash. You did not pay any cash for depreciation. Therefore, you ignore depreciation expense. We also ignore loss and we also ignored gain. Why? Because, and we explained this under the indirect method, but I will do it again. Loss, when you record a loss, let's assume this loss was because you sold a piece of land. When you record the loss, you will debit, let's assume you had a piece of land and you purchased it for 114 and now you sold it for 100. So I'm going to credit the land 114,000. I'm going to debit cash 100,000. I'm going to debit cash 100,000. It means I have a loss of 14,000 and I will debit my loss 14,000. Now this loss I did not pay $14,000 in cash. I did not make that payment. It reduced my net income, but I did not make the payment. If anything, from a cash perspective, I received cash. But that loss is, what is it considered? It's a non-cash. It's a non-cash. Therefore, what do? I ignore. I cannot convert something that's non-cash into cash. The whole sale of the land is 100,000 and I will account for that cash in the proper place, which is what? The investing section. The same concept for the gain on the retirement. I retired a note and I have a gain. Well, yes, I retired the note and I have a gain. Well, that $30,000 gain, whatever gain I have, let's do the journal entry. Let's assume I had a loan for 100,000. So I have a notes payable, a note for 100,000. I'm going to debit the note 100,000 to remove it. I'm going to credit cash. I only paid for that loan. I paid off the loan with 70,000. It means I created a gain of 30,000. Once again, this is a gain, and the gain is a non-cash. The cash is 70,000. I will account for that cash, for the total amount of cash on the financing section. Therefore, you ignore gain, you ignore loss, you ignore depreciation expense. You ignore any non-cash revenue or expense. This is the rule. Why? Because they're already non-cash. Now, when we did the indirect method, notice we made adjustment for depreciation, adjustment for loss, adjustment for gain. Why? Because those numbers were factored into net income and we needed to take them out. Under the direct method, they were not factored into anything. We ignore them. Since they are non-cash, we simply ignore them under the direct method, because under the direct method, you take each line and you convert it into cash. If the account is a non-cash expense or a non-cash revenue or a non-cash gain, you don't touch it. So we started with cash received from customers. We computed this number: cash paid to supplier, cash paid to wages and other expenses, cash paid to interest, cash paid to expenses. When we net them out, obviously they are going to be the same, because whether you use the direct or the indirect method, the answer is the same. It's a different way of getting to the answer. Now, which method is used more in the US? The indirect method. 99% of companies use which method? The indirect method. You need to know both. Understanding both, knowing both will be helpful, whether you are an accounting student, a CPA exam candidate, CMA candidate. What should you do now? You want to go to Farhat Lectures and look at additional resources. Resources such as additional lectures, multiple choice, true, false, exercises that's going to reinforce everything that you need to know about the direct method. Statement of cash flows using the direct method. Invest in yourself. Farhat Lectures is always here to help, and stay safe.